Hello, everybody. My name is Stephane Prigent. I'm the CEO of Katch Investment Group. With me on this webinar today, we have Maria Ryan, based in London. She's our head of risk management. So thank you very much for joining this webinar, in which we will provide an update on our global lending fund. Just as a reminder, so within Katch, we currently manage 5 funds. Global Lending Opportunity is our flagship fund, the one that we created first. It's getting to $120 million asset under management, and we're getting to the 3-year track record. This strategy has 3 main pillars. The first one is direct lending. Then we have a real estate bridge loan and factoring. During this call today, we're going to give you an update on the return of the fund. We get back to all the initiatives we took over the last 6 months, and we're going to give you an outlook for the rest of the year. So on this particular slide, you can see the return of the fund over the last 4 years. And as you can see, the return are very stable, steady. And above all, there is absolutely no correlation with traditional assets, such as equity and income. So this is really the goal of this fund, is to provide an uncorrelated strategy to our investors. You can see on this table the performance over the last, since inception. The returns, the target return is around 8%, but most importantly, what is important for us is to have a steady, stable returns. We never had a negative monthly return, which is extremely important for us, not even during the COVID crisis. And the year-to-date performance annualized is around 6%. Which is slightly lower than our target return, but is still pretty good. And this is coming to the first initiatives we took over the first half of the year, which is to exit. We had about 20% exposure to external investors, external asset managers, and we are in the process of exiting all those strategies. So we took the returns of those external asset managers was a bit lower than our expectations, and we took the decision to actually manage everything in-house in order to have higher returns, also to have more transparency on the entire portfolio, on all our positions, basically. So we expect the second half of the year to have a stronger return and to get closer to our target return by the end of the year. As a reminder, we manage 3 main strategies within this sub-fund. And the first one is direct lending, which we mostly do in continental Europe. Maria is going to give you an update on this specific strategy. Then we have real estate bridge loan that we mainly do in the UK market, and I'm going to give you a quick update on that strategy. And finally, factoring in Brazil, and we also have a bit of exposure to the UK market, and I'm going to give you an update on that strategy as well today. This is the current composition of the portfolio in terms of a strategy breakdown. So you can see that our main exposure is on direct lending with about 50%. Then we have exposure to real estate bridge loan, 23%, and factoring 20%. So we're quite happy with those current weights. We do not anticipate to have a big change during the second half of the year. And we believe that this composition allows you to meet our target return while still providing liquidity to investors. This is the composition, the breakdown in terms of geographic exposure. So our main exposure is on continental Europe, mainly via direct lending, as we saw before. We have a big exposure to Brazil. This is the only exposure we have to emerging market country. I still believe that Brazil offers very good return for the risk that we take over there. And finally, we have quite some exposure as well to the UK market via mainly via real estate bridge loan. But so we still have a bit exposure as well to North America and Asia, and this is really to make sure that we diversify our portfolio as much as possible. Liquidity remains of paramount importance for us. Obviously, we provide liquidity on a monthly notice, which means that investors get their money within about 2-3 months. As you can see on this chart, I mean, we have about 25% of the assets that can be liquidated within 3 months, and about 65% of the assets that can be liquidated within 6 months. So we feel that this is good enough in order to be able to meet our liquidity constraints. So quick updates on our UK real estate bridge loan strategy. We currently have 16 loans in the portfolio. With the portfolio size about $35 million. We currently have an LTV of 66%, so extremely conservative. That means that the value of the loans, the value of the collateral is about 6%. We could bear a market correction of about 30%, and that will not affect the value of our book. The duration is extremely short as well, 6 months, which means that we have money coming back to the portfolio every month, and that's liquidity that we can give to investors that potentially wanted to redeem from our funds. We have a strong tilt toward residential with 75% exposure to residential, mainly middle market houses from £200,000 to £500,000 with relocation in Greater London from Zone 2 to Zone 8. Everything we do is 100% first lien, senior secured. So we probably have one of the strategy that's the most conservative in that space. We never use leverage, and our LTV and duration is probably shorter than most of our competitors. The percentage of construction as well in the book is extremely low, below 30%. So we manage this strategy with a team of about 6 people in London, and we try to keep that very conservative profile. What happened in the UK market, the real estate market remained extremely strong. If we look at 2020, the market went up 6% in terms of prices in spite of a recession of 8% in the UK, in spite of Brexit as well. So it is really perceived as being a safe haven asset. During this year, again, prices are really quite stable. We have never seen that much activity in the real estate development in the UK. There is still a huge deficit of houses that we estimate at 1.5 million houses. So the market is doing extremely well. In the book, we don't have any loans that are not performing. All those 16 loans are performing extremely well. We had some extension. We had 2 loans that we had to extend, but we remain extremely confident relating, on the collaterals that we have in front of those loans. The downside of, I would say the only negative point of this healthy market is that a lot more lenders came back to the market. So now we have a lot more competitors than we had a year ago. And sometimes we had to compete a bit more on the terms, which are LTV and yield mainly. and we saw some loans, actually, some borrowers actually that redeemed before the maturity of the loans because either they were able to, to refinance their loan at a lower rate, or they managed to sell an asset before the maturity of the loans. So this is the second initiative that we took during a couple of months ago. Is we hired an extremely senior sales person called Mark Jones, that is also based in London, in order to improve the origination capability for the specific strategy. So now we have 3 people on the origination side, one being extremely senior, and now we have a lot more deals that actually we can finance every month, which is a good problem to have, because we actually can select the deals that we like the most. So overall, it's a strategy on which we have a lot of capability to grow. We're growing the book about 3 million a month, but if we wanted to, we could actually grow much more than that. So now I'm going to move to our factoring strategy that we mostly do in Brazil. As a reminder, the Brazilian market for us is probably the best market in the world to have a factoring strategy, because that's the only one that is regulated by the local authorities. And as a reminder, the bank system is actually extremely concentrated. 5 banks have 80% market share, and they are not willing to lend to small and medium companies. So our portfolio is growing at a healthy pace, about $2 to $3 million every month as well. It's true that in Brazil we currently have some political instability with the potential impeachment of the president. The economy remains still fragile because of the COVID situation. We expect the economy to grow about 5% this year, so it's a nice recovery from last year, but we still maintain a very conservative approach with our portfolio. So we're extremely selective, and we have a strong tilt towards the most conservative sectors, such as oil and gas, food and beverages, construction, agribusiness, and transportation of goods as well. So we believe that in those specific sectors, not much can happen. If we look at the default rate, it went we averaged about 1.5% per year. It went up to 3% during the COVID crisis, and now it's back to 1.5% pre-pandemic levels. So if you look as well at the appreciation of the local currency, you can see that external investors are a lot more bullish on the Brazilian economy, and they believe that the worst is really behind us. In the book, we don't have any all delay, or actually the NAV of that specific strategy is calculated on a daily basis at the local level in Brazil, and all the provisions have already been taken. So there's no fear for potential loss for this specific strategy. Situation is getting much better in Brazil. Now we have about 50% of the population that had its first dose, and 20% that had the 2 doses. So that's, in Latin America, that's probably one of the country that is the more advanced with the vaccination. One point on inflation, obviously the inflation is a bit high now. It's about 5%. It's supposed to get back to 3% towards the end of the year. But the central bank started to increase interest rates. So the interest rates are around 4.25% now. And the cost of hedging went up, obviously, from 2% last year to 4% now. So this is the cost of hedging with the dollar, obviously, which is the most important one for us. So everything we do is completely hedged, obviously. The cost of hedging reduced the performance, but that's being compensated by the yield of the receivables that you buy at the local level. So currently the yield is 1.6% in average per month. And we believe that this yield will continue to increase a little bit to actually compensate potential increase by the central bank that we may have in the future as well. Yeah, overall, I mean, it's the situation is getting better in Brazil, but we will keep our extremely defensive tilt towards the most conservative sectors. The average duration is only 45 days, so it's a strategy that brings a lot of liquidity to our portfolio. And this is why we like it so much. So now I'm gonna hand over to Maria. She's gonna give you a quick update on the portfolio for direct lending. And actually, we are coming now to the third initiative, which actually improve our capability to do direct lending. So this is why we hired Maria at the beginning of the year, and this is why we also increase our network of contacts to be able to originate a lot more deals via direct lendings. Maria, over to you.
Hi, everyone. I'm Maria Ryan. I'm the risk manager for the Global Lending Opportunities Fund. My role includes monitoring our direct loan portfolio and also underwriting new loans. I'm going to talk about our new loan screening process, give some highlights of our portfolio in the direct lending space, and also talk about new initiatives, as Stephane mentioned. So in terms of sourcing new loans, we really cherry pick the best senior secured risk reward loans, which we source through a wide network in Europe of real estate brokers, tax audit and wealth advisors, private equity sponsors, and family office investors. We favor creditor-friendly jurisdictions for secured lending. What that means is, in the unlikely case where there is a payment default and we need to enforce, and the enforcement is non-consensual, the courts will favor the lender. As you will know, in England and Wales and the Netherlands and many of the Nordic countries are creditor-friendly. Germany, Switzerland, Austria have a balanced approach. And there are other jurisdictions where we have investment expertise, such as France and Spain, where we will be even more selective and have a higher threshold for structure and due diligence, because the courts will favor the borrower, so they're not creditor friendly. Now, what the advisors and clients value, and we've received that feedback, is that they are dealing with decision makers. In the 1 million to 10 million ticket range, the banks are typically not active, and if they are, they will take a long time to underwrite a loan in excess of 6 weeks or even longer. And there will be alternative funds present as well, but those tend to come in over 20 million tickets. So really, we are in a sweet spot where we've seen very little competition in Europe. Where we have, it doesn't tend to be consistent. It will be 1 or 2 competitors, which vary deal by deal. So we're looking at opportunistic financing situations where the investor is taking advantage of an asset value creating strategy or wants to acquire an asset. Speed of delivery is critical, and there we have local partners, valuers, legal counsel that can work with us to perform targeted due diligence and provide certainty of finance. We do not compete on price. The borrower profile is very important. We only deal with professional and established private and corporate investors that have an experience in their local markets and a track record. Typically, they will also have a finance team, which helps us with the monitoring post-execution. And the nature of the collateral is key. It'll be well located. That doesn't necessarily need to be central prime locations, though we have done loans in central prime locations. It can be secondary city towns, university towns, or the periphery of urban areas. As Stephane mentioned, those tend to see a lot of growth in major European cities, demographic growth, and therefore demand. We can also look at operational real estate in creditor-friendly jurisdictions where the borrower will be, say, a healthcare provider, residential care, logistics business, which owns and operates from its own real estate. And there we have the underwriting expertise to execute these loans at conservative LTVs. We typically take cross-collateral to other business assets, so receivables, inventory, equipment, intellectual property, or investor assets. We prefer direct asset cross-collateral versus a general personal guarantee. We always use third-party valuers, so RICS or equivalent, and we look at what is the current asset, what is its use, and if we had to sell it in 180 days or in a liquidation, what would we get for it with the current planning permission in place. And we study how has this asset class behaved through previous cycles and where are we now. And at the LTVs we lend at, which are typically 50 to 70%, we will be covered even if there is a macro shock. The exit must be known and realizable at the time of entry, and we will favor assets with high liquidity, where there is a lot of investor demand should we need to enforce and liquidate. So on the next slide, we can see an overview of our direct lending portfolio. So since the last update, we have done one major loan, which is to an impact fund in Luxembourg. That is an opportunity that came from our network directly, proprietarily sourced. And there we have a very low LTV. We've got 240 million US dollars of operational real estate collateral for a 10 million US dollar loan. Now, how were we able to achieve this? Well, we were able to lend at the fund level, at a Luxembourg fund level, first in the waterfall of proceeds ahead of LP investors, and with a covenant in place as to the net asset value and negative pledges, so no other liabilities could be created at fund level. The interest rate is paid quarterly, cash pay, and we also have renewal fees. So if you look at the annual rate of 12.7%, it is lower than the effective annual rate, which includes the upfront fee, but does not include the renewal fees that we get every 6 months for renewing that loan, which is 22 months. We're very happy with that borrower, a very professional borrower. We get quarterly reports. We engage with them directly, and we've got very good visibility of exit of that loan. That is a fund finance facility, and we've done another one to an existing previous borrower recently as well, called the UK Real Estate Fund, the last one on the slide, also at very good rates. That illustrates how we can be opportunistic and seize opportunities as they come along. The impact fund, we had one other competitor that wasn't able to match our ticket size. And in the UK Real Estate Fund, we had no competitors. Another example of a good loan we have is the Amsterdam Bridge, prime central real estate, recently refurbished. We extended that loan for a further 6 months as the renovation that the investor did is complete now, and he wants to maximize value by refinancing through a bank, which will take a further 6 weeks rather than sell, even though the market at the moment is very liquid and very strong for central prime Amsterdam real estate. The other loans are performing very well. We have an active portfolio management team led by me and another colleague. We engage regularly with borrowers and ensure that they're meeting their covenants. The asset value management strategies are performing. For example, they're engaging with construction companies. They're refurbishing the property. And all the covenants are being met on a regular basis. So overall, our weighted average effective rate is 13.1% for a very low LTV of 28.9% and a duration just under 2 years.
Thank you, Maria. So we come back on the 3 initiatives that we launched during the first half of the year. The first one was to have a lot more transparency on the anterior positions that we have in the book. So basically, that's why we exited the exposure that we had to external asset managers. The second initiative was to hire a senior salesperson in London in order to increase our capability for origination for the real estate regional strategy in the UK. And the third one was to hire Maria Ryan and be able to improve our internal skills for direct lending strategies, and to also build a strong network of contacts in continental Europe to be able to access the best deals for direct lending. So we managed to achieve those 3 initiatives. The next steps for us is to launch this new European Secure Lending Fund that is going to be managed by Maria Ryan. That's for investors that just want to be exposed to direct lending. The target return will be 10%. The focus will be on deals that have a duration between 1 and 4 years, so probably 1.5 years in average. And in that particular case, it will be impossible to provide monthly liquidity. So the liquidity will be semi-annual with 9-month notice. So basically, what the extra return you get will come with lower liquidity, obviously, and otherwise the terms will remain the same. So this specific strategy is in the IPO phase and will be available to external investors from September 1st. As you can see, I mean, we basically use, so the launch date will be officially August 1st. And here we just use, we build that track record using all the loans that we have done internally within GLO since 2019, basically. So that's going to be the next initiatives. And the second initiative that we took as well is to create a US feeder fund for GLO for US investors. So it's going to be an LP Delaware structure in which US residents, US investors will be able to invest directly, and this feeder will only be exposed to the Global Lending Opportunity Fund. So thank you very much for your attention today. So now we're going to take some questions. So if you have any questions, please just click on the Q&A button, and we will answer them right away. So I'm going to stop sharing my screen so then I can read the questions. So we have one question on the fact that we reduce our exposure to external managers, and someone asked in which kind of strategy those managers were invested. So most of them were invested in real estate bridge loan in countries where we did not have the capability to do it ourselves. such as the US market, for instance, which is obviously quite specific. And a lot of them were also involved in trade finance. So if you want to do trade finance, obviously you cannot just do it with one or two portfolio managers. You really need to have a proper team in place. When you look at the team that we have 6 people for real estate bridge loan in London. So that actually that's a proper team, and we have 10 people in Sao Paulo for our factoring strategy. So if you want to do it in-house, you really need to invest, and so it's actually better to do it via external asset managers. But because those external asset managers reduce our performance, and we also have been asked by investors to make sure that we have full control on the entire exposure. That's why we took the decision to exit those specific strategies. We have a question on the July month performance. I mean, I cannot really comment on that, unfortunately, because I know it should be a strong month, the month of July. From time to time, we happen to negotiate a small upfront as well when we do direct lending. And I know that we manage. There's one that is coming for the month of July. So the month of July should be good, but I don't want to give any indications because the probability of getting it wrong is high enough for me to actually keep it for myself. But it should be in line, if not better than the month of June, where the performance was about 62 bips for the dollar USD share class, the institutional share class. So what is the aggregated maturity of the fund? Is it different from the liquidity availability graph that you showed? No. Actually, those. So the maturity for the fund doesn't really have its own maturity. Obviously, it's an open-ended structure, meaning that people can get in or out whenever they want, and there is no specific maturity for the fund that you may have in a closed-ended structure. So obviously, what I show in the charts were the maturity of all the single loans that we have in the portfolio. Okay, so if, for instance, if we have a bridge loan that will mature in 3 months, that would have been in the first 25% that I showed in the specific charts. We have questions about the average LTV on all the strategies. So in the real estate bridge loan here, it's quite easy actually to be able to show the average LTV, and that's probably the one that mattered the most. It's around 66%, which is also kind of the average at the portfolio level, which was about 65%. When we talk about factoring, obviously that's the LTV. It's a bit different here, because when the factoring, what you have in collateral is the receivables that you will, which obviously the obligation of the buyer to send the money to a specific account where you can get your money back. When we happen to have a credit line that is starting to get too high, and it's not that high actually, it's around $200,000. Then we ask from the producer, the one that is selling his good, to actually provide another collateral to us. And most of the time we ask for real estate collateral. I mean, like such as his own house, for instance. So we make sure that the position, when they start to become a bit large, we always ask for extra collateral. Most of the time, real estate. It could also be other things like such as trucks, machines, something that we can seize and that we can sell. That's always the objectives. So just keep in mind that the average invoice size is only $10,000. So it's extremely low, which allows us to always be extremely diversified. And the obligation is on the risk. The credit risk is on the buyer, not on the producer, because the money is supposed to come from the buyer. So then I have, is it the finance UK fund? Okay. Yes, so then we have a question, is the finance UK real estate fund your own one or third party? So it is our own, everything is done in-house, as I mentioned before, and the UK real estate fund is our own strategy, is our own fund. And if people were to be interested, not in the multi-strategy short-term duration fund, that this is the one that we presented today, but only want to be exposed to the UK real estate fund, that's also possible. That's our second fund that is called GLO. And you can always get access to that. It's the same with the strategy in Brazil. If people wanted to be just exposed to the factoring in Brazil because they only want to have very short-term duration strategies, it's also possible. The fourth strategy being the litigation finance, and the fifth strategy being the one that we presented today, the European Secure Lending Fund. Great. I think I don't have any additional questions. I mean, if someone wanted to, I mean, we're always available to organize calls and to answer more questions if you had any. Next month we will focus on our litigation fund that is getting to 1 year history. Performance has been quite strong. I mean, we are running around between 13 and 15% annualized return. And the idea is to make sure that you are aware of what we're doing in that specific space, and also maybe to educate you with this new asset class that may be a bit new to some of you. Thank you very much for your attention today. Bye-bye.
Thank you. Thank you.